Well, it has been a big month for tech IPOs. Renren, LinkedIn, Yandex have all gone public, and some say Zynga might file for an IPO next month. Our good friend Iyan Adewuya is with us at the deal desk. He is Bloomberg's senior M&A analyst. He's here to talk about the top IPOs, the banks that are benefiting as well. Iyan, always glad to see you on a Friday, especially. So we've had a lot of activity this month so far, right? Tech targets, what kind of numbers are we talking about here?
Well, it's a pretty big number. You have $62 billion in tech M&A this year alone. And if you actually look at the contribution of tech deals into the global M&A market, that's about 6% of global volume in terms of deal volume. That's about 30% of global deal count. And so, tech really had a hard, the tech industry really had a hard time during the crisis.
There weren't many IPOs at all during the crisis because the exit would have been so painful.
Correct, and there weren't many deals either. But if you look at the numbers we are now, that $62 billion number and the $39 billion of deals we had just in the second quarter of this year alone, that's a 3-year quarterly high. We haven't had that number all the way since the fourth quarter of 2007. So deals are coming back in the tech sector.
So, Iyan, is it just the fact that the credit crisis is over, more companies do have cash on their balance sheets, and they're ready, or are there other factors at play?
Well, there's some serious factors at play here because the deals that are happening are deals that have to do with the so-called smart world. So it's smart mobility deals and cloud computing and social networking together with the underlying software and operational applications to power these devices. That's really driving a lot of deals, and that's causing consolidation in the tech sector.
So you mentioned this $62 billion figure. That's what we've seen so far this year as far as tech targets go. How much, if we look quarter on quarter or year on year, of the total value does that represent?
Well, if you shift over to what we're seeing in IPOs, which is what you were talking about earlier, you have a 13% increase in the total volume of tech IPO deals. And then if you look inside tech, you have a 400% increase in the total value of internet IPOs. Now, clearly, they were down so much, which is why they're up so much now in terms of internet. But it's still a pretty stunning number to see how far back we've come. And this is pretty significant driver of IPOs in general.
So banks obviously all vying, right, to work with these hot tech companies. Which ones have you seen get the most business?
Well, some of them have had a pretty good week. Morgan Stanley, for instance, has had a really good week, 2 weeks, as a matter of fact, when you look at what they did as the lead underwriter for LinkedIn, and again, as the lead underwriter for Yandex. 2 stories where you had the price range go up and price at the top of the range. The guys at Citi maybe not celebrating as much, where they had the Freescale IPO and the Spirit Airlines IPO that were both reduced in terms of range and then priced at the very bottom of those ranges. So clearly some good and bad weeks out there.
And just to kind of remind us how this whole system works, I mean, the LinkedIn's IPO had enormous success the first 24 hours of trade and then really cooled off. What does that mean for Morgan Stanley?
Well, you can interpret it 2 ways, and there's this parlor game going on now, which is, did the underwriters do a good job? Some people would say, well, how could they anticipate such a pop? But there's a line of thinking that says for these tech IPOs, they have to be priced to pop. Otherwise, no one wants to touch them.
And we know they controlled the demand, right? Or they limited. In fact, I even know Yandex, for example, right about a week early, just cut off how many institutional investors could be involved. Yeah,
so there's that game as well, where you have to be smart about controlling demand and then limiting the number of shares that you're going to float out there, so that bearish investors don't kind of jump in and beat it down. You've seen a little bit of that with LinkedIn, but there's some built-in bear traps there, which is why, actually, in my opinion at least, you haven't had a full crash with LinkedIn so far.
Built-in bear traps. Iyan Adewuya, thank you very much. Senior M&A analyst joining us there on the deal desk.